Hello and welcome to the FinWell Daily Brief. This is our 60th briefing, and we're jumping right into the financial markets. All the data we're looking at is based on the closing numbers for today, Friday, June 13th, 2025.
That's right, and it's been quite a day. Definitely some global tremors making waves locally.
For sure. And we're here to give you the essential rundown nice and quick. So let's kick things off, as we usually do, with our financial fact of the day.
Okay.
Now, this one might surprise you. Did you know that nearly almost two-thirds of household wealth here in India is still tied up in physical assets, property and gold?
Wow, 2/3. That's significant. It really speaks to, the cultural weight, the tradition.
Exactly.
Gold, real estate. They're tangible. People feel secure with them. It's generational.
Right. And even with financial markets growing, more awareness about, say, equities or mutual funds for maybe better long-term growth.
Yeah.
That preference, that deep-seated thing for physical assets, It's still incredibly strong. And for you listening, it's just a good reminder, isn't it? Wealth building looks different everywhere. Understanding these preferences, even the traditional ones, adds real context to your own investment thinking. It's not always just about the highest return.
No, absolutely. History, security, these things matter. It shows decisions aren't purely based on financial models. Far from it sometimes.
Okay. Let's pivot then. Let's look at the hard numbers from today's close, June 13th, around 3.3 BM IST. And, it wasn't exactly a day for the bulls.
No, quite the opposite, really. We saw selling pressure pretty much across the board. All the main indices finished lower. The benchmark Nifty 50, it closed at 24,718.60. That's down 169.60 points. Translates to a drop of 0.68%.
Okay, so a clear step back for the big names.
Yeah.
What about the wider market, mid-cap, small caps? Did they hold up any better?
Not really, no. They didn't escape it either. The Nifty Midcap 150 ended at 21,433.05. That's down 76.60 points, so a loss of 0.36%.
And small cap?
Small caps were down too. The Nifty Small Cap 250 closed at 17,210.40, which is a drop of 66.50 points or 0.38%. Even the Nifty Total Market Index, the one that gives you that really broad picture.
Yeah.
That was down too. Closed at 12,898.95, shedding 77.65 points or 0.60%.
So a pretty consistent story then. Caution, selling, right across the market spectrum today. Wasn't just limited to large caps?
No, the general mood definitely pulled everything down.
That broad slide really is telling. Okay, let's shift to the debt market. Do we see the same kind of pressure on government bonds?
Not quite the same picture there, actually. India's 10-year government bond yield, it eased a bit today, moved down to 6.28% from 6.35 yesterday.
Oh, interesting. Why was that?
Well, traders were looking at the global volatility for sure, but also factoring in the Reserve Bank of India's, continued neutral stance on policy. So lower yields mean bond prices ticked up slightly, often a sign of money seeking safer harbors.
Right. Bit of a flight to safety, maybe? A slight disconnect between the equity mood and the debt mood.
You could say that, yeah. Although falling yields do point towards some demand for safety.
And the rupee. It's been bouncing around a bit lately. How did it fare today?
The rupee actually showed some strength today. It firmed up against the US dollar, closing at 85.07.
Okay.
This recovery, from the weakness earlier in the week, it seems partly down to some support from the RBI in the currency market, and maybe a slightly better sentiment around foreign flows today. Stabilization, perhaps.
All right. So stocks down broadly, bonds showing a little defensive strength with lower yields, and the rupee managing to gain some ground. That's the snapshot. Now, the big question, why? What was the main thing pushing equities down today?
The dominant factor, without a doubt, was geopolitical tension playing out globally, specifically reports around Israel's actions impacting Iran that really rattled risk sentiment worldwide. And India, being, plugged into the global financial system, felt that impact directly. Risk aversion kicked in.
So global jitter is overshadowing local stuff for the day.
Yeah.
That makes sense. And that explains why you said the selling was so broad-based, hitting all sectors.
Exactly. When global risk appetite sours like that, investors tend to pull back from riskier assets pretty much everywhere. We saw every single sectoral index on the NSE end in the red today.
Every single one. Wow.
Yeah. Sectors like auto, consumer durables, FMCG, metal, IT, power, oil and gas, realty. They were all down somewhere between 1% and 2%. And some of the big names really dragging the Nifty down included Tata Motors, Shriram Finance, and Trent.
Wow, okay. That really paints a picture. Global fears hitting home right here on Dalal Street. Now, amidst all this selling, there was some company-specific action too, right? An IPO opened today.
Yes, that's right. The Cotton Papers and Foam SME IPO, it opened for subscription today. They're looking to raise rupees 31.68 crore. It's a fresh equity sale.
31.68 crore. Okay. And what's the price range they've set?
The price band is 91 to 96 rupees per share.
91 to 96. And for anyone listening who might be thinking about it, what's the minimum check size?
Right. For retail investors, the minimum application is one lot. And one lot contains 1,200 shares.
1,200 shares.
So if you apply at the top end of the band, the 96 rupees, that works out to a minimum investment of rupees 1.15 lakh.
1.15 lakh rupees. That's quite a ticket size for a minimum investment in an SME IPO.
It is, yeah. It's significant.
So what exactly does Aiden Papers and Phone do? What's their business?
They position themselves as an intermediary, basically in the paper supply chain, connecting paper mills with end users, particularly in the packaging sector. They did show strong revenue growth last fiscal year, FY25. Revenue was up 43% to about 138.7 crore rupees.
Okay, 43% growth sounds good, but...
And this is important, their profit margins are notably thin. And the business is very dependent on, well, two things: demand from the packaging industry and the fluctuating prices of raw materials, paper itself.
Got it. So growth on the top line, but maybe some question marks around profitability and dependencies. Speaking of external factors, what about the foreign portfolio investors, the FPIs? What were they up to today?
Well, FPIs continued their recent trend. Pretty cautious. We saw net outflows from them again in June. Huh? And this fits right in with the global picture we talked about, the uncertainty, the tensions. During times like these, emerging markets like India often see foreign investors trim their positions, pull capital out. It's classic risk-off behavior.
Makes perfect sense. Fear rises, money leaves perceived riskier places. But surely it's not all negative sentiment. Are there other perspectives out there?
Oh, absolutely. You have to balance the short-term noise with the longer view. While today's action reflects immediate global concerns and FPI moves, big institutions, they often maintain a longer horizon for India. Morgan Stanley, for instance, held their India Investment Forum recently. And they basically reiterated their optimism about India's long-term growth story, despite this kind of short-term volatility.
Interesting. What are they pointing to as the drivers for that long-term optimism?
They highlight a few key things. Robust macro stability, first off, then continued government spending, particularly on infrastructure, and third, what they see as the start of a new private sector CapEx cycle, companies starting to invest more in their own expansion and growth.
Okay.
These are seen as the fundamental strengths, the pillars supporting India's potential over the next few years, kind of irrespective of these daily market swings.
So the market today is reacting to fear, FPI flows.
Yeah.
The immediate stuff. But underneath, the long-term structural growth narrative for India is still seen as strong by some major global players.
Exactly. It's that classic tension, isn't it? Short-term sentiment versus long-term fundamentals.
And navigating that is key.
Precisely. That's the heart of investing, really.
Okay, we're going to pause for just a moment here. When we come back, we'll dig deeper into that Aiden Papers and Foam IPO we mentioned. Stay with us. Welcome back to the Finwell Daily Brief. Just before the break, we touched on the Aiden Papers and Foam SME IPO. Open today, closes June 17th. Price band 91.96 rupees, looking to raise about 31.68 crore rupees, and that minimum investment we mentioned, rupees 1.15 lakh.
Right. And for you, the listener, especially if IPOs are on your radar, this one really warrants a closer look, because while that revenue growth number might look appealing on the surface, there are several, let's call them red flags, significant ones that potential investors really, really need to be aware of before jumping in.
Red flags. Okay. Always important to look for those, especially with that higher minimum investment for an SME stock. Let's break them down. What's the first big concern?
First off, it's those thin margins we touched on earlier. The company's profit after tax margin, the PMAT margin, was just 2.87% in FY25.
2.87%. That sounds low.
It is very low, especially in a sector that's known for being highly competitive. Thin margins like that mean there's very little cushion if costs go up or if they face pricing pressure. Just for context, a healthy business in this kind of space might be looking at margins quite a bit higher than that.
Okay, so thin margins, definitely a point of concern. What's next?
Next up is high debt. The company's debt-to-equity ratio stands at 2.23.
2.23. How does that compare?
Well, generally, a ratio above 1 is considered on the higher side. So 2.23 is quite elevated, it signals significant leverage, meaning the company's relying heavily on borrowed funds. High debt always increases financial risk, makes the company more vulnerable if revenues dip or, say, interest rates climb.
Right. So thin margins and high debt, that's not a great combination. What about their actual business structure? Any flags there?
Yes, there's significant customer and sector concentration. Their business relies heavily on just a few large clients, and those clients are mostly within the packaging sector. So that creates a vulnerability, you see. If demand in packaging slows down, or if one or two key customers run into trouble or just decide to switch suppliers.
It could hit Ayton disproportionately hard.
Exactly. It has a much bigger impact than if their customer base was more spread out.
Okay, so concentration risk. And finally, we already mentioned it, but that minimum investment amount itself is kind of a factor here, isn't it? Especially when you stack it alongside these other points.
Precisely. That high minimum investment over 1.15 lakh rupees per lot for retail investors, it's a substantial commitment. Putting that kind of money into a single SME stock, especially one showing these kinds of red flags, the thin margins, the high debt, the concentration risk, well, it demands a pretty high tolerance for risk.
So if you put all that together, the low profitability, the heavy debt, relying on a few customers in one sector, plus the high entry cost, what was the sort of the critical takeaway on this IPO?
The critical take is this. Yes, there's recent revenue growth, which is positive, but the underlying fundamentals reveal some pretty significant risks. The combination of thin margins, high leverage, and those concentration issues makes the Ayton Papers and Foam IPO, frankly, a high-risk bet. It seems particularly unsuitable for more conservative investors, or maybe for anyone who can't really afford the possibility of a significant loss on that single investment. Anyone thinking about it must do their homework, understand these risks deeply.
That's really clear, and it underlines just how vital it is to look past the headlines, isn't it? Especially with IPOs, and maybe even more so in the SME space.
Absolutely. It's not just about getting in on something new. It's about understanding the business you're potentially buying into, warts and all.
Right. And that brings us back to the wider market picture. So, given the geopolitical situation, the FPI outflows we discussed, and these kinds of IPO-specific risks, what's the general outlook and maybe some analysis for investors right now?
Well, the immediate outlook definitely remains cautious. Markets are clearly feeling the pressure from those external factors, the geopolitics, the resulting FPI selling, the fact that selling was so broad today, hitting nearly every sector, with autos and energy getting hit particularly hard. That just underscores the risk-off mood we talked about.
Risk-off meaning investors are just stepping back from things perceived as more uncertain.
Exactly. Selling assets sensitive to economic or geopolitical shifts and maybe moving towards perceived safety.
Okay, so where might that perceived safety be found in this kind of environment?
Well, typically, defensive sectors tend to hold up relatively better when volatility is high and risk aversion is up. So you might look at sectors like, say, pharmaceuticals or FMCG, fast-moving consumer goods. They may offer a bit more stability compared to the more cyclical sectors. Also, worth noting, with the rupee strengthening a touch today, sectors like IT and other big exporters could potentially see a small positive impact down the line when they report earnings in rupees, though, of course, that depends heavily on their specific hedging and billing practices.
Okay, so maybe leaning towards defensives, potentially keeping an eye on exporters if the rupee stays firm. What's the kind of overarching advice, then, for navigating these choppy conditions?
I think the most consistent advice in times like these is really to prioritize quality. Focus on companies with strong fundamentals, healthy balance sheets, clear, understandable business models. Maybe be cautious with highly leveraged mid-cap or small-cap names, as they can often experience much sharper swings during downturns. And as our IPO discussion just highlighted, be extremely careful and do your homework on any new offerings, particularly SME IPOs that might carry those kinds of red flags we identified. Thorough research is really your best line of defense.
Quality and caution. Sounds like solid advice.
Yeah.
Are there any specific technical levels for the Nifty that traders might be watching for potential support?
Yes, on the technical side, analysts are looking at the 24,600 to 24,700 zone as a potential support area for the Nifty index.
Okay.
There's a possibility the market could find a base there and maybe stage a rebound if, and it's a big if, global cues stabilize. If those geopolitical tensions ease up a bit, sentiment could improve, and we might see buyers step in around that support level.
Right. So 24,600, 24,700 is the zone to watch, but it really depends on the global backdrop improving.
Absolutely. It's highly contingent on that.
Okay. Now, shifting focus slightly, but staying on the theme of investor protection, There's a really critical warning we need to share with you, our listener. It's particularly relevant when the IPO market gets busy, and that's the danger of IPO fraud.
Yes, this is incredibly important, something everyone considering the primary market needs to be aware of. IPO fraud is unfortunately a very real risk.
How does that kind of fraud typically work? What should people be watching out for?
Well, it can happen in a few ways. Sometimes the company itself, or perhaps parties involved in managing the IPO, might deliberately mislead investors. They could, say, exaggerate the company's future prospects in the prospectus or other marketing materials. Paint a picture that's just too good to be true. Or maybe they downplay or even hide critical information about risks or weaknesses. The aim is usually to lure investors in with these false promises, ensuring the IPO gets fully subscribed, often at a price that isn't really justified by the company's actual condition.
That sounds incredibly deceptive and dangerous for investors. How can someone protect themselves? What are the practical steps?
Protection really comes down to vigilance and sticking to the official channels. First, always download and thoroughly read the official prospectus that's filed with SEBI. Don't just rely on summaries or flashy ads. Go to the source document. It legally has to contain detailed information, including the risk factors.
Okay, read the full prospectus. What else?
Check the company's filings directly on the SEBI website. Verify the information, and be extremely skeptical of any unsolicited pre-IPO investment offers you might get, especially if they come from unregulated sources or people you don't know. Stick with registered brokers and official platforms. It sounds basic, but doing this homework, being cautious, it's essential for navigating the market safely and avoiding scams.
That is such critical advice. Thanks for stressing that. Doing the due diligence, being wary of unofficial offers, it can save people a lot of potential pain.
Indeed. The market offers opportunities, yes, but there are pitfalls too. Staying informed and diligent is your best defense against them.
Okay, as we start to wrap up today's Finwell Daily Brief, let's just quickly recap the main takeaways from what was certainly a dynamic day.
Right. So Indian markets fell for a second day running. Sentiment was really driven by that global risk aversion sparked by geopolitical news. And this led to pretty widespread selling across almost all sectors.
And while that Eaton Papers and Foam SME IPO did open today, our deeper dive highlighted some significant potential risks. Thin margins, high debt, concentration, making it a high-risk proposition that needs very careful consideration.
Exactly. And for investors navigating this current environment, the core advice is focus on quality companies, maybe avoid overly speculative bets, especially in highly leveraged midcaps, and approach all IPOs, particularly SME ones, with thorough research. Look for those potential red flags under the surface.
Great summary. Staying on top of both the big picture forces and the nitty-gritty details, like those IPO risks, is just so crucial.
It's about connecting the dots between the macro and the micro.
And that brings us to the end of today's Finwell Daily Brief. We really hope this overview helped you make sense of the day's market movements. To make sure you don't miss these daily updates, please do subscribe wherever you listen to your podcasts.
And if you have follow-up questions or want to discuss any of this further, please feel free to connect with SOS Finwell on LinkedIn. We're always happy to engage there.
Before we go, we'll leave you with a quote. It feels quite relevant, actually, to India's underlying economic strength, even when markets feel volatile.
Frugal innovation and resilience are India's greatest investment strengths.
A powerful thought. And finally, just the standard disclaimer. This briefing is for informational purposes only. All the market data we discuss comes from SEBI-registered exchanges and official regulatory filings. It is absolutely essential that you consult with a certified financial advisor before making any investment decisions. They can provide advice tailored specifically to your situation and your goals.
That's right. Everyone's financial journey is different, so personalized, expert advice is really irreplaceable.
Thanks so much for tuning in today. We'll be back again next time with more essential insights from the financial world.